doing, guys? This is Quan Warren coming back at you. You know what I'm saying? I appreciate all the love today that I received. Thank you for that, guys. Gonna keep on giving y'all the best content that I can. You know what I'm saying? Of course, you know, everything that I know, well, for the most part, a lot of the foundation that I know came from multi-million-dollar hedge fund manager, my mentor. So only giving y'all grade A information time after time. I only use grade A information. And so today I was thinking about it. I know that we were supposed to talk about basically ramping up on profits on your profitable trades. And I think that it's, I'm gonna save that one for next week, but I'm gonna make a quick note on that though before I move on, and I'm gonna tell you the reason why. Just for y'all that are doing that, and you know, make sure that you're not negatively averaging into your positions. A lot of the times Fibonacci is used to, in a sense, negatively average into a position, which is good if you know what you're doing and if you have already set forth a plan ahead of time and you have your risk predefined and you have reason to believe for ABC reason that you should have pre-positioned, you know, past your initial position. And that's actually what I want to get into today is about preserving capital. I think that's, you know, a very famous trader once said that rule number one in trading is to preserve your capital. Rule number two is to never forget rule number one. And so I think that's very important. It's a lot more important than trying to, you know, aggressively ramp up on trades just because they go a few pips in your favor, which is what I see a lot of people doing. I'm part of a lot of communities on Reddit and different social platforms. So I see that, and you know, it feels good when you're doing it, but definitely you know, backfires. It's just like a time bomb. You want to know how to do that systematically, and we're going to get into that next week. But for this week, I want to talk to you guys about preserving capital. All right, so excuse me, sorry. All right, so when you guys are making, excuse me, when you guys are placing trades, you know, whatever currency pairs you're doing, whatever asset class you're trading, you guys know that I'm a foreign exchange trader. That's just my preference. A lot of my, wouldn't say friends, but associates, you know, that are also traders, try and get me to move over to indices and stuff like that, saying it's more profit potential, more volatility. That's all well and good, but I do believe that, and I know for a fact that every market has its characteristics. You want to learn your market's characteristics. You really don't want to bounce around all too much, especially just haphazardly. You want to kind of know what it is that you're getting yourself into. I know a lot of the times you guys see different assets, you know, they're making these big moves and you're like, oh, well, I want to get in that. Well, before you do that, you might want to learn about the characteristics of that particular asset, because every asset has a behavior pattern, just like every human does. Even in foreign exchange, every single currency pair behaves differently as you guys probably already know, and that is even more so outside of foreign exchange, where the liquidity is different, where the dynamics of trade are different. So learn it before you jump out there, because you might find yourself in a position where you don't want to be. Aside from that, I wanted to talk to you guys about preserving capital though. So when you get into a trade, first thing that I think that you guys should know, you're most clear-headed before you enter a position. And what I mean by that is trading takes objectivity, not subjectivity. Now, I know a lot of people may scoff at that and say, well, then where's the whole discretion in discretionary trader? Well, there's an element to discretion as far as manual trading is concerned, but it happens before you place a trade 9 times out of 10. And as you grow as a trader, and as you grow in your experience, sooner or later, you'll know specific times when it'll be okay for you to break certain rules. They won't happen all the time, won't happen super often, but they do happen where you get to the point where you're competent enough that you can break certain rules with comfort, knowing that you're gonna, your trade is gonna be better off because of that. And but that's not a habit that you should make. Definitely isn't a habit that you should try to adopt. It's something that happens over time. Like as you grow your track record as a trader, it happens over years, 10 years or more. Sometimes it's and you want to make sure that you're consistently profitable before you ever try and break any rules, and you want to make sure that you have rules. And that's what I want to talk to you guys about today, about your trading plan. When you are getting ready to place a trade, you never get into a trade just randomly. See, now I was taught by my mentor, before you ever even touch the screen, you get a piece of paper, you write down your asset that you're getting ready to trade, you write down the direction that you're getting ready to trade it, you write down why, the fundamental reason why, the sentiment-based catalyst why, and then you write down your take profit and you write down your stop loss and why your take profit and stop loss. Because when you're not on the charts, those are the times when you are the most objective. Trading, 99% of it is being objective. If you're not objective as a trader, then you will possibly have some luck, depending on the circumstances, but ultimately in the long run, I can guarantee you won't last long and you will lose money and it won't be fun. And I've been there before, and I can tell you that it is a very, very devastating thing to have happen if you let your emotions take over and you're not objective about your decision making. So, trades, before they're ever implemented on a platform, must be written down, formulated properly on a piece of paper where there are no emotions involved. And this isn't a hard and fast rule. You guys don't have to listen to me. I've been doing this for a very long time. I've learned from one of the best in the world, not in the country, not in the state, but in the world. And I can tell you for a fact that this works. I can tell you that if you don't do it and if you try and cut corners, that you will see the difference. As soon as you press the button, buy or sell, once you're on the chart, the whole dynamic is completely different. You go from being maybe 99, 95, 98% objective to 50, 40, 30, 20% objective, almost just like that. And the reason is because now your emotions are now involved. And the reason why your emotions are involved, obviously, because your money is involved, right? So you want to have your plan and you want to have it concrete before you get on a trade. And that is the best way in order for you to preserve your capital, to have a plan, stick to the plan, and don't let that subjectivity get in the way between your entry and your exit. If your exit happens to be a stop loss, learn to take it. Trust me when I say there have been a lot of traders that don't learn to take it, and they end up getting their career is very, very short in trading. They don't ever make it. They don't ever get the money that they're looking for. They lose everything and they leave. And that's the end of their story as far as trading is concerned. Don't want that to be you guys. And so learn to take your losses. It's part. This trading is a business. It's not a gamble. I know a lot of people say that. Statistically speaking, though, if you look at it, 95% of traders come into the market with zero education, unlike any other profession that I know, and lose all their money within 2 years and never recover it and are done with trading. And so, the sentiment that trading is gambling amongst many people isn't really all too shocking when you consider the fact that people approach trading kind of like a fool, like a fool would, to be frank, and there's something called the Dunder-Kruger syndrome, where you know so little about something that you think that you know everything that there is to know about that. A lot of times people will read a book that says things like, how I made $1 million in the market over a year, and then all of a sudden finish the book and think they can go and make $1 million and get their head blown off in the market, and then wonder why and say, oh well, it's just trading is gambling. It doesn't work. It doesn't work. No, it does work. It works, but you have to know what you're doing. And just like any career, you have to get the right education, right? So you wouldn't read a book about becoming a brain surgeon, for example, and then think that you can go into an operating room after reading a 200-page book and anesthetize somebody, cut their calvarium open and reach into their brain and start tinkering around. Wouldn't do that, right? So what's the difference with trading? There really is zero difference, and I think that the fact that people don't realize that, because it seems on its face to be simple, is where a lot of people get caught out at. And so for the guys that follow me, I want you guys to be better than that, smarter than that, know what you're getting yourself into, and know how to properly approach it. Another thing that I wanted to touch on, aside from having a plan, a concrete plan, is placements of your stop loss and your take profits. So that's a very, very big thing. I hear a lot of the times people say stuff like, Well, is my broker stop hunting me? Is the market stop hunting? Yeah, they are. And it's part of the business. Now, what I will say about the brokers, not necessarily that they're stop hunting you per se, like how the institutions are, because they are specifically stop hunting you. But the brokers, what they do when they see a trader, um, see, brokers usually have two different books of traders. They have their A book and they have their B book. Okay, if you find yourself on the B book, on the bad book, then you find yourself in a position where your broker is now trading against your positions at all times because your broker has determined that you are losing money, and to trade against you is an extra income stream for them. So, for the guys that are out there that don't have consistent records as far as winning in trading and being consistent, and if you find yourself on the B book, which obviously is not something that you can just readily find out, but yes, a lot of the times, especially if you have market maker brokers that you're using, they are going to trade against you because they're a business. You know, you're an income stream if you allow yourself to be. Period. It's just that simple. And so don't be on the B book. And you don't be on the B book by not being a bad trader. And you don't be a bad trader by learning what you're doing before you do it, sticking to your rules. And in order for you to stick to your rules, you got to have rules, right? So formulate a workable trading plan. If you're going to do this as a career, you want to take this serious, and you don't want to be one of those people that jump in all haphazardly, lose all their money within 2 years, never come back. That's the 95, 96, 99, whatever percent that you always hear about, the exact number. I've heard so many different ones. The majority. If you don't want to be the majority, and the majority hands down are losers in trading, because, and for one, and let me also say this, is that people don't lose in trading because they're not good at doing things. Trading is something that takes a set of mental and emotional skills that we aren't, as human beings, pre-wired with. You know, we are reward-seeking creatures. By definition, we always, everything that we do, if you break it down to its smallest part, is to gain a reward and to get away from some sort of pain. That's it. That's the essence of what drives our behavior. And in trading, you kind of have to rewire that, because the type of behaviors that you usually see that end people's careers in trading, let's say for example a common one, moving your stop loss as the market gets close to it. So why would you move your stop loss away from a price when the market's getting close to it? It's because you don't want to have that pain of realizing that loss. You want to have the ability to be able to hold out hope that just maybe in a few pips the market's going to turn around, and then I'm going to at least be able to get break even, or I may even get a huge profit. What's that? That is your reward that you're hoping for. That usually never happens. Sometimes it does. I've seen it happen. But for the majority of the times, it does not happen, and it ends catastrophically. So you end up taking a small loss, and making it into catastrophic loss that cuts a huge chunk out of your account. Now you can't trade, your positions are small and goofy and you feel dumb, and when you should have just taken the loss. But that's pain, and so that's not what you're wired for. That's just one example of how we aren't wired to be successful in this specific arena, although we may be successful, very successful elsewhere. So for those of you that see this, that are not successful, but that you're successful other places and you're wondering why it's not unique to you, that is the nature of trading. So I just wanted to point that out. One last thing that I definitely wanted to point out as far as formulating your trading plan, guys, is that going back to the stop hunting, institutions do that, and it's not a thing about you. It's really more so about them, for them to be able to place their positions. So it's not really about like, trying to come after you guys. I mean, it definitely is that, but it's not. That's not the framework behind it. What it is jumping into a liquidity pool in order to be able to place my positions. And see, institutions and even retail traders have access to, I know you guys have probably heard about order books, market depth, all those types of things, right? Well, institutions have those types of tools times 100, times 1,000. They can literally see where clusters of trades are, where clusters of orders are. Retail brokerage firms place their orders in bulk. That's how we gained access as retail traders to a otherwise inaccessible arena, was because brokerage firms came in and they were able to pool our positions up to a point where banks would take them, as retail traders not having enough money to be able to place a flat out position, most of us anyways, with the bank. And that's why for a long time trading was exclusive to the ultra wealthy alone, right? So point is that when you guys place your orders, and you got to think, everyone's looking at the same levels. So everyone's looking at the same charts, everyone's looking at the same price points, everyone's looking at the same psychological levels, and I'll get into psychological levels with you guys on another video. I'm not gonna do too much with that right now because that is pretty in depth. There are more than just 00 or 50 levels. There are a lot of different psychological levels, and it also depends on the pair that you're trading, which goes back to knowing your pair. But aside from that, let me just keep it basic right now for you guys, is that when you're looking at when you're looking at a support or resistance level, and let's say you guys are looking at euro dollar and it's at 1.1250, and you're like, well, dang, 1.12 is a super hard support. The price bounced off of that 3 times. It's solid. I can put my stop right underneath that. Don't do that, okay? Because I'll tell you what, a lot of people are thinking just like you. And the people that are moving the market can see all of those positions that are pulled up right there, and they will run the price specifically into that zone, right into your stop loss, in order to be able to liquidate your position and open up their position and run the price back. So when you guys say, well, am I being stop hunted? Yeah, you are, but it's avoidable, and it's really like it should be something that you should do just kind of as you grow as a professional trader, intuitively. Don't ever put your stop loss right on the level that you feel like the price shouldn't pass. You always want a buffer, okay? That's it's kind of like a school of fish, and then the shark just comes through, and the shark isn't gonna come for the one fish over here. It's gonna come for the school of fish over here. So if you guys put yourself with the school of fish, and that's what you're doing when you place it at these obvious places, your stop losses, for example, you're putting yourself, you are now one of the fish in the school of fish, and the sharks will come get you all, and that's just what it is. So what you want to do is you want to buffer, and you know, the buffering depends on the specific pair, the volatility, the situation, you know, because you could sometimes have a bigger buffer than other times. More times than not, 25 to 30 pips behind that major level is enough of a buffer. You'll usually see a price penetrate maybe 5 to 15 pips into a resistance level, a major level, before creating that order block from the institution and then running the price back. Rarely will you see it push past 5 to 15 pips. Sometimes if it's like super extreme, if there's a lot of stops there, it might run it like close to 20, 25-ish, but that's very, very rare. 30, that's like more than likely not gonna happen to you guys unless you're trading into a major news event and you are improperly positioned. 1, 2, you don't have enough of a stop to account for your volatility that you're getting ready to experience. Excuse me, and we'll talk about more as far as news trading later on, because and then this is one thing that you guys should know, is that most big institutional traders don't trade the actual event. You know, they trade either into it or out of it, you know, because the event itself is called uncertainty. Like, you don't know what's going to happen. You don't know if the consensus will be right, and you're not going to ever see the number come out, as I told you guys before, and get in before everybody else, because there are institutional feeds that get those numbers seconds and sometimes way more than that before you guys. The big institutions know what the numbers are coming out as well before you guys ever will even think about knowing what the numbers are, and so you have zero chance, not including the fact that they have now these high frequency trading systems that within a fraction of a fraction of a fraction of a millisecond can get into and out of hundreds and thousands of trades. I mean, the technology now with the banks is so advanced that within nanoseconds they can be in and out of many bundles of trades. And so you have, as a person clicking a button from a home computer, zero chance. And I want to make that very clear, okay? Up against these high frequency trading systems. So you don't want to even, and really, you don't need to go against them to make money. I mean, it's literally pointless to try, like, but you don't have to do it at all, because you can make money trading without even delving into that, and I'll go into that later on. But the point that I really wanted to make for you guys: leave a buffer, like, leave space. My mentor used to say, like, you want to give your trade space to breathe. Okay, so like, let's say if you're trading, a head and shoulders is one of the patterns that I tend to favor. And they come in many different forms. Sometimes they're complex, sometimes they're simple. Sometimes they're very, very distorted, and that is by design, because they're meant to be incognito, so to speak. But the more that you are in the markets, the more that you'll be able to recognize those incognito head and shoulders patterns. What you want to do, whatever pattern you're trading, whatever situation you're trading, whether it's fundamentally based, whether it's technically based, whether it's purely sentimentally based, what you want to do is you want to find the point on the chart where once the price passes that chart point, like substantially, then your trade is invalidated. And from that point, then you want to move past that point with your buffer in order to get away from the herd, so to speak, right? So never placing stop losses on any type of psychological 00 levels, never place stop losses on any type of 50 levels, never place stop losses on the psychological 15 levels, because that's a big one, as well as the 85s. There's a few, and I'll go through all of those with you guys in a later video. Never place your stop loss at a major support, major resistance, minor support, minor resistance, wherever you think that the market should not go. And this will take experience and time for you to know when your trade has objectively been invalidated, okay, or not. You want to have a buffer past that point, okay? So, because I've seen people, they have good setups, but they place their stop loss right up underneath the support. Market comes down, grabs liquidity, bow, pops them right out, 5 pips down, it bounces, and it pins up, and it's gone in their direction. They're like, well, damn, I just lost X amount of money for no reason other than because they didn't know how to play stop losses properly. So that's one of the big things with regard to your trading plan. So you want to have your trading plan and everything set. The work is done before you get on the chart, not when you're on the chart. There is no work to be done once you're on a chart. The work is done before, period. Okay, so always remember that once you're on the chart, you're hands off. If you're a professional, you do the work happens, but it happens before you ever click any single button, period. Remember that, okay? Because once buttons start getting clicked, subjectivity starts to dramatically go up, and your chances of making an emotionally based decision rise exponentially. Very, very fast, especially if the market is moving against you at that moment. So always stay objective, and you do that by doing the work ahead of time, placing your position, letting it run, and fulfilling your plan. Whether it hits a stop loss or a take profit, you learn from it, you put it in your notes, okay, and then you learn from it and you move forward. That's it, right? That's what a professional trader does. All right, that's what separates them from the rest of the people that are on the charts trying to maneuver their way through, moving all emotional and, oh, let me move my stop here because the market's right there. Let me move my stop. Let me move my take profit. Don't do that. Set a plan, execute it, leave it. That's it. All right, and then so the last thing I want to get to with you guys is the setting of your take profit. So let's say you're running a position on pound yen or pound dollar or whatever you're trading, and you identify a level where you believe that the market's going to at least hesitate, if not have a mid-level or full retracement, you never want to place your stop on that level. Okay, you never want to place it on that level. You want to place it inside of that level. So my mentor used to say this. He used to say, I would rather have 85% of something than 100% of nothing. And what that means is that if you try to squeeze every single drop out of a trade, then the chances start to rise very quickly that you will lose that trade completely for no reason, okay? Because the market can flip around quicker than you may expect, and so once you identify your level where the take profit should be, place your stop loss about 10 pips in, 15 pips in, 5 pips if you're pretty confident, but at least in between 5 to 15 pips. And to be safe and to be real, I place my stop loss about 20 pips in. I do long, highly volatile positions. So to me, 20 pips is kind of like, it's almost like it doesn't even make any difference at all. But I know that there are a lot of people that are placing trades where they're trying to get in and out, in and out, in and out. And so 20 pips to them may sound like, oh my gosh, that's a lot. Well, consider the fact that, your spread on any given session close can widen almost 20 pips, 10 pips, depending on what you're trading. There are very illiquid parts of the market depending on the time, especially 5 o'clock when New York closes and Asia is not fully opened yet. Depending on what you're trading, your spreads will widen somewhere in the area of 5, 10, 15 pips. So in reality, placing your stop, your take profit 20 pips in, it's not really a big deal if you think about it. And as I said, you want to get at least 85% of something rather than 100% of nothing. All right, so I'm going to leave you guys with that. I thought that was very, very important for me to get to today before we go into ramping up positions, how you pyramid, because I know that a lot of the times people, when they first start trading, their emphasis is solely on making the biggest amount of profit possible on a position. That is important. I do the same thing to a certain extent, but I also have the knowledge to know where and how and why and when to be able to do those types of things and how to be able to do them properly. And we're going to get into that next week, guys. This has been Quant Warren. I'll see you guys next week. Have a good day.